Hello, and welcome. Today, we're going to talk about the Dodd-Frank Act and its impact on the mortgage industry. If you're considering taking out a mortgage, understanding this important piece of legislation can help you navigate the loan process with confidence. What is the Dodd-Frank Act? The Dodd-Frank Wall Street Reform and Consumer Protection Act, commonly known as the Dodd-Frank Act, is a comprehensive piece of legislation passed in 2010 in response to the 2008 financial crisis. Its primary goal is to increase transparency and stability in the financial markets and protect consumers from abusive practices. One of the key components of the Dodd-Frank Act is the creation of the Consumer Financial Protection Bureau, or CFPB. This agency is responsible for overseeing and enforcing regulations related to financial products and services, including mortgages. Their mission is to ensure that consumers are treated fairly and have access to clear and accurate information when making financial decisions. So, how does the Dodd-Frank Act affect your mortgage? There are several important aspects to consider. Ability to repay rule. One of the most significant changes introduced by Dodd-Frank is the ability to repay rule. This rule requires lenders to verify a borrower's ability to repay the mortgage before approving the loan. Lenders must consider factors such as your income, employment status, credit history, and existing debts. This ensures that borrowers are not overextended and can afford their mortgage payments. Qualified Mortgage (QM) standards. The Dodd-Frank Act established standards for what is considered a qualified mortgage, or QM. A QM is a loan that meets specific criteria designed to protect borrowers and reduce risk for lenders. For example, QM loans typically have limits on fees and points, require a reasonable debt-to-income ratio, and do not have risky features such as negative amortization or interest-only payments. If a loan meets QM standards, it provides more protection against potential legal issues for lenders and ensures that you're getting a loan with more predictable terms. Disclosure requirements. The Dodd-Frank Act also introduced stricter disclosure requirements. Lenders are now required to provide clear and detailed information about the costs and terms of the mortgage through documents like the loan estimate and closing disclosure forms. These documents help you understand the total cost of the loan, including interest rates, fees, and closing costs, so there are no surprises at closing. Anti-abuse protections. The Dodd-Frank Act includes provisions to protect borrowers from predatory lending practices. It restricts certain high-risk loan features and requires lenders to provide accurate information about the loan terms. This helps to prevent situations where borrowers might be misled or taken advantage of. In summary, the Dodd-Frank Act plays a crucial role in the mortgage industry by enhancing transparency, ensuring that loans are affordable and fair, and protecting consumers from abusive practices. As you move forward with your mortgage application, keep in mind that these regulations are designed to safeguard your interests and provide you with a clear understanding of your loan. If you have any more questions about the Dodd-Frank Act or need assistance with your mortgage process, feel free to reach out. I'm here to help guide you through every step of the way. Thank you for watching, and I look forward to assisting you in achieving your homeownership goals.